I sit across from business owners every week, smart, successful people, and almost all of them are making at least one of these five mistakes, usually more. Mistake number one, and it's the biggest. Your accountant and your investment advisor have never spoken to each other. I see this constantly. You've got a great CPA doing your corporate tax return. You've got someone at a bank or brokerage managing your portfolio, and they're operating in completely separate universes. Your CPA doesn't know what's in your portfolio. Your investment advisor doesn't know how your comp structure works. Nobody's looking at the whole picture. And the result? You're making tax decisions that might contradict your investment strategy and vice versa. This is exactly why I consider myself a financial quarterback. My job is to sit in between you and your professional team and make sure everyone is running on the same play. Mistake number two, you're paying yourself the same way every year because that's what my accountant set up. Salary versus dividends is not a set it and forget it decision. It's a moving target that changes based on your income, your RSP room, your CPP desires, your spouse's income, and honestly, about a dozen other variables. A lot of business owners are paying themselves entirely in dividends because someone told them it's more tax efficient. And sometimes it can be, but if that means you're building zero RSP room, you might be missing out on one of the best tax shelters available to you. Mistake number three. You have a pile of retained earnings sitting inside your corporation, and it's either in a savings account or it's in a cashable GIC earning next to nothing after tax and inflation. Corporate investment taxation is its own universe. The passive income rules, the refundable tax mechanisms, how investment income affects your small business deduction, this stuff is genuinely complex. And if your advisor doesn't specialize in it, they might not even know the right question to ask. That money should be working for you, not in some aggressive, risky way every single time, but in a structured, tax-efficient, and evidence-based way that actually accounts for corporations and how they're taxed differently than individuals. Mistake number four, you're building a business with no plan for what happens when you want to stop. Whether you're planning to sell down the road or transition to a partner or even just wind down the business, the decisions you make right now affect how much you can keep in your pocket when that day finally comes. Your lifetime capital gains exemption, your corporate structure, how your assets are held, whether you've been purifying your shares. If nobody's modeling your exit, even a rough version, you're building a house without a blueprint for the front door. And mistake number five, you stuck with the bank because it was easy. And I get it. Your business account is there, your line of credit is there. They offered to take a look at your investments. It seems really convenient, seems like a good relationship. But bank branches are product distributors. Their advisors are often limited to proprietary products, usually expensive mutual funds. They're measured on sales targets, not retention. And the advice you get is shaped by what's available on their shelf, not by what's best for you in your specific situation. I'm saying the incentives of advisors at bank branches aren't always aligned with yours. And for someone with your complexity, that misalignment can cost you real money over time. If you recognize yourself in any of these mistakes, you're not alone. These are just the most common patterns I see, and the best part is they're all fixable. The first step is getting someone to look at the full picture. I'm Harry Sale, financial advisor at Raymond James. I'm an evidence-based planner for business owners and incorporated professionals. If you want to take a meeting with me, my Calendly link is in the description.